Many people think that the housing market should crash with these sky-high interest rates, but it hasn't happened yet. So in this video, we're going to talk about why the high housing price and the high interest rate are happening at the same time, why Federal Reserve failed to reduce the American housing price. So this chart is S&P CoreLogic Case-Shiller U.S. National Home Price Index. It shows the overall picture of the home price in U.S. And it's at all-time high. So since right before the pandemic, which is end of 2019 until today, the national home price has risen 50%. This is the same index, but it's shown in the year-over-year format. And as we can see, post-pandemic, right, at about second half of 2021 and first half of 2022, the year-over-year growth of the National Home Price Index peaked at about 20%. And then in March of 2022, Federal Reserve started the hiking cycle, and the year-over-year growth started to decrease. And in May of 2023, the year-over-year growth went below zero, meaning a year-over-year decline. And today, the thing climbs back up. We're at about 6.5%. And right now, the home affordability is also very bad. The home has become more expensive faster than the speed people are getting wealthier or richer. So this chart shows you the income required to buy a median value house, which is shown in orange, versus the median household income in US, which is shown in gray. Right? The gap between the two right now, it's substantial. It's about $35,000 a year. Right? So there is a big spike in the income required for a median home in the year of 2022 since the start of the Federal Reserve hiking cycle. So the Federal Reserve raising interest rate definitely made American homes less affordable. So what is causing the current real estate resilience? One reason, or the most important reason actually, is it's very hard to find a home to buy. So this chart shows you the existing single-family home for sale. Right? It's pretty much at the lowest point since the 1980s. Right? So obviously there's a drop in supply. This is the beginning of pandemic. There is a drop in supply because many owners are holding onto their properties instead of trying to sell them to upgrade their homes. Why? Because they do not want to give up their ultra low interest rate, because in America you can get 30-year fixed mortgage rate. This chart shows you the gap between existing mortgage rate, which is the gray line, and the new mortgage rate, which is shown in the black line in America. So with the current 30-year fixed mortgage rate at around 7%, the amount of money you can save just by keeping your old mortgage loan is substantial. As we can see, there is a 3.2% gap between the two. So many homeowners are stuck due to this gap, even though, let's say, for example, somebody was planning to upgrade their home, but they can't because of this gap. But of course, for the people who are downsizing their homes, who do not need a new loan, this is not a problem for them because they can just buy with cash. But a recent report has shown that a significant trend among the baby boomers who are actually retiring, right? They actually prefer to stay in their homes, in their original house, instead of downsizing to move to a retirement community, meaning that if they were to downsize, their existing home would be out in the market. But because of the trend that they prefer to stay in their old homes, it hurts the supply of the existing homes on the market. On the other hand, the home builders are doing their part. This chart shows you the new homes for sale as a share of total single-family inventory. So currently, above 30% of the single-family homes on the market are new homes, right? New homes that are built by the builders. It's actually a historical high, right? But again, this is a percentage number, so this also shows that our existing homes on the market are very weak, right? Making the new home more predominant supplier of the inventory. This chart shows you the new single-family homes that are completed but not yet sold, showing that the American builders are trying very hard to meet the demand. Right, so it's currently at 100,000, which is at the same level of 2010, and we can obviously see an uptrend. So as a conclusion to this video, right, as stimulus wealth continue to wear off or run off, people will have less and less money to purchase homes. And also less money to purchase anything else. That's why we're seeing the inflation going lower, CPI at around 3% year over year. And also as the builders are slowly picking up their home building, eventually I think two forces combined are going to help lower the home price. The problem is it's going to take time, right? And right now, Federal Reserve is expected to cut interest rate in the second half of this year. At first, it's probably going to boost, help with the home affordability at first. But as a result, medium to long-term result, it's going to boost the demand for buyers, right? Because your mortgage rate are going to get affected. They're going to get reduced. So if the supply of the home doesn't keep up with the increase in demand, right, the home price is going to continue to go higher. So it does seem like Federal Reserve failed to suppress the real estate price, because this resilience is actually linked to the current resilience of the U.S. economy. Because we didn't actually suffer a recession, so people are still feeling rich. The unemployment rate is low. Stock market is doing good. But if in the future U.S. do experience an actual economic downturn, an actual market recession, a market crash, that will for sure lead to people thinking or feeling less wealthy because of the so-called wealth effect. And that's, I think, is the only way to actually make a substantial dent in the real estate market, to actually diminish the demand for the housing market. Okay, thank you. Please don't forget to subscribe.